It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to contact me, you can do so at yourpersonalbank.com. Again, that's yourpersonalbank.com. And yes, you will reach me. So some of the newest news, of course, has to do with GDP and inflation and the Federal Reserve. The latest numbers that came out is GDP has slowed. That means the amount of growth has slowed. And inflation has increased at a higher rate than what the quote-unquote experts predicted. Now, I think this is really interesting because, as they stated, GDP shocker and inflation shocker, except on Main Street. I don't know where they get these experts from, or these Wall Street people, or whoever they may be, but they're not living in the real world. This was no surprise to anyone who's paying attention or living in the real world. The reality is, if you go shopping or buy your own gas, you understand what's going on with inflation, certainly. And the economy slowing down, that was pretty obvious to anyone who was paying attention. So they really need to start asking people like myself who pay attention to this, who live in the real world, deal with real people, real clients on a daily basis, just like you who are listening to me right now. I deal with everyday folks. I wish they would ask me and people like me about what's going on, and maybe they wouldn't be so surprised or shocked so often. Again, no shock to me. As a result of that, of course, the 10-year Treasury yield has now jumped to the highest level in over 5 months because of the GDP report. When the economy is not doing so well, when inflation is higher, when you have slower growth, bonds are going to be stronger because they're considered safer. And for example, before we get into that, we'll a little bit more here in a second, but some numbers on the inflation. January 2020 to January of 2024, the overall average increase on typical grocery store items, stuff that the average American purchases, the average increase is now 46%. In other words, your grocery bill is now on average 46% higher than it was 3 years prior. And I'm not telling you anything you don't know if you're one of those people that actually goes to the grocery store and actually pays any kind of attention. Now, why is this so important? Well, one of the things, we all know this higher inflation numbers now reinforces the Federal Reserve stance on interest rates higher for longer. I know I've been discussing this with a lot of people, and I hear a lot of people contacting me when I talk to them, or they're listening to the legacy media or Wall Street, and they keep saying, well, we're going to have rate cuts. It's not happening, folks. In fact, at this point, now even the quote-unquote experts are finally agreeing with what I've been saying now for, over a year or two now, is that we're going to have higher inflation for longer. And even the Federal Reserve, to their credit, has been stating for some time that interest rates are going to be higher for longer. And the reason behind that is, of course, inflation numbers are higher and continue to stay higher than their target rate of 2%. And until that changes, the Federal Reserve is not going to lower interest rates. They keep repeating that, yet Wall Street and legacy media types and stuff, I guess out of hope, maybe, keep saying, well, the rates are going to get lowered soon. The rates are going to lower soon. I understand why they want that to be the case. It's good for stocks and the stock market in general for a lower interest rate environment. It's also good for real estate. But hopium, and that's exactly what it's been, is not reality. And again, I would rather tell you what you need to hear rather than what you want to hear, because that's how you make better financial decisions. Look, I'm an optimistic person by nature. I'm an upbeat person by nature. And I am still bullish on the long-term economic future of this country. But I'm very bearish on the short term for many, many reasons. And the latest numbers are bearing that out. Our economy is slowing down. It's obvious if you just look around and pay any kind of attention. Inflation continues to be a problem. Prices continue to rise, obvious to anyone who's paying any kind of attention. And then the third leg of this stool is unemployment is starting to rise. Now, I understand the government numbers, they're keeping them artificially low, so it looks better than it really is. But when you dig into the numbers, and I've shared this on this show a number of times, we have had now in the past year about 1 million real loss of full-time jobs. The numbers they're counting primarily are part-time jobs. Yes, there is an increase in part-time jobs, but that is not good for the economy. The other part of it that's kind of hidden in the numbers, most people don't pay attention to, is many of these new jobs happen to be government jobs, which do nothing to contribute to the economy. The government does not, it's not the train that runs the economy, it's actually the caboose. Business is the economic engine. It's the engine of the train that makes the economy go forward and go well. The government is nothing more than the caboose. It's all along for the ride. And if you get too many cars, if the caboose gets too big, it slows down the engine because it has to pull too much weight. And maybe that's a good analogy for you. It's clearly and abundantly obvious as the government continues to spend more and more money, more than it receives, that is going to be a drag on the economy and growth. The purchasing power overall of the dollar, of your purchasing power, has in the last 3 years has been about 25%. It's higher with food prices, as stated. The average actual increase over the last 3 years is 43%. Overall, the average increase of just about anything is 25%. That means you're 25% poorer than you were 3 years ago if your income happens to be the same. Unless you've increased your income by 25% in the last 3 years, you are poorer today. You have less buying power today than you did 3 years ago. That is inflation. That's the insidious tax, hidden tax, if you will, of inflation. And anybody, again, that pays any kind of attention, you instinctively know this because more and more money's going out, and you go to the grocery store and the bill keeps getting bigger, and yet there's not more stuff in the cart. In fact, oftentimes there's less stuff in the cart. And that's why we're starting to see articles dealing with something called stagflation. We're going to have to discuss that today because that is something we haven't seen since the 1970s. What is stagflation? Stagflation is basically a combination of slow economic growth and high inflation. It's a double whammy. It also typically includes higher unemployment. Again, we have not seen that type of economic scenario since the 1970s. There's a ton of articles now come out due to the slowing economic growth, slowing GDP, continued strong inflation, and increasing unemployment that are leading more and more people, more and more experts, to think that a soft landing, in fact, here's the CEO of JP Morgan, Jamie Dimon, stating himself he's skeptical about the odds of a soft landing. That the market, he believes, is pricing in a likelihood of a soft landing at about 70%. He says the numbers look far more like the 70s to me. As he stated, things looked pretty rosy in 1972, but were not rosy at all in 1973. He thinks, again, this is Jamie Dimon's opinion, that the odds of a soft landing are about half of that. So he thinks there's about a 1/3 chance now that our economy manages a soft landing, yet the market is, as he put it, pricing in about double that. Should we be concerned about stagflation? Well, what that does states mounting evidence is pointing to a nightmare scenario for the U.S. economy. And again, what they're referring to is stagflation. That will mean higher interest rates for longer, higher inflation, slow growth, higher unemployment. That is the combination of stagflation. That, of course, will in general be very poor for the stock market. If you look at the 1970s, it was not a pretty decade. We have even had a bank failure now, Republic First Bank. Now, granted, it's a small bank, but is it a harbinger of things to come? Is it the canary in the coal mine? Are we going to see more bank failures? The odds are greater, certainly, than they were before. Stagflation is a situation where the assets that thrived in the last decade, low interest rate environment, easy monetary policy, it was cheap money for businesses to grow, expand, good for the market, obviously beneficial to real estate values, low interest rates are. We are in the opposite now. The economy has completely changed. 180 degrees. Everything that did well before is most likely going to struggle in the next decade, and everything that struggled in the past decade or didn't do so well is probably going to thrive. Perfect example, it's very obvious. If you head to the bank today versus a couple of years ago, you couldn't get 1% on a CD, even a long-term one at a bank a couple of years ago. Most of us remember that. It wasn't very long ago. Today you can get 4 and 5% on a bank CD or money market, those kinds of things. That's a dramatic change. That is, in fact, like a 5-fold, 6-7-fold increase from what we could get just a couple of years ago. That gives you an idea of the significance of the difference. You want to change your investment strategy going forward. The economy has changed and is not changing back anytime soon. The Federal Reserve is telling this. You want to be involved, much more involved in interest rate sensitive assets than you were before, and your personal bank happens to be one of those leading assets. Stay tuned in the next segment. I'm going to share more about stagflation, what we likely are going to be facing going forward, and how you can thrive through stagflation rather than suffer through it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can contact me at yourpersonalbank.com. Yes, and if you do that, you will be able to reach me. Again, it's yourpersonalbank.com. One of these statements I've been making quite a bit lately is how the economy has dramatically changed from just a couple of years ago when we had easy monetary policy, low interest rates, and things like the stock and real estate markets were thriving. No doubt. It was, frankly, one of the best decades in the history of the stock market ever. That's a statistical fact. To expect the same types of results going forward is highly, highly unrealistic because everything has changed. In fact, article after article and expert after expert is now discussing something we haven't heard or been familiar with since the 1970s, and that is something called stagflation. And again, that stagflation is slow growth, high interest rates, typically high inflation accompanies that, obviously, higher unemployment. And we are definitely in the realm of being at risk to be facing that. If it happens or not, we'll see. But I got articles like this talking about the Magnificent Seven. If those of you who don't know, if you've been investing in the market, there's basically 7 stocks in the last year or two that have done extraordinarily well. They're all tech stocks. They've been kind of dubbed the Magnificent Seven. That's Amazon, Apple, Google, Nvidia, Meta, Microsoft, and Tesla. And they have had spectacular growth in the last year or two. There's no question about it. But as this article states here, the Magnificent Seven is over, and look to interest-sensitive assets because interest rates have gone up significantly, and the Federal Reserve themselves has stated because of higher inflation, higher interest rates will be here for longer. Most experts are now predicting we will not see any type of rate cut through the rest of 2024, at least, if not longer. Remember, it wasn't too long ago, so many people were saying, we're going to have, 3, 4, I even heard 6 rate cuts in 2024. Personally, I thought that was highly unrealistic because I was looking at the facts on the ground, the economy, interest rates, inflation, what's going on. I was not surprised by slowing GDP. Again, I'm a Main Street person, not a Wall Street person. I deal with average Americans across the country every day. I'm blessed that way. I probably have a better handle on the economy and what's going on in real lives financially than most anyone else in the country. And I'm not saying that to brag, it's just a fact. I have the rare opportunity of speaking to people from coast to coast on a regular basis because the show airs coast to coast. Most financial advisors, through no fault of their own, are regionally based, or they're focused in a certain city or town or state perhaps. So they may be familiar with their area, but not so much what's going on really across the country. It's not unusual for me to be talking to somebody in Florida and then California an hour or two apart and everywhere in between, literally. So when the GDP numbers came out, like these GDP shocker, quote unquote, and then in parentheses, except on Main Street, I was with that. Didn't surprise me at all. Changing to interest rate sensitive assets or having that as a bigger portion of your portfolio would be a very wise move with interest rates being higher for longer. Again, as the Federal Reserve is stating. Now, there's several things you can do. What are some interest rate sensitive assets? These are the questions I get all the time. Well, of course, the most familiar most people have is bank money, CDs, money markets, things like that. You can invest more of your money in those areas. Obviously, they're paying much higher interest rates than they were a couple of years ago. That's a significant advantage. If you're working with a FDIC insured bank, for example, then the money's safe. That's a definite advantage. Disadvantages, of course, are the rates are strong now. They may or may not last for a while, although it looks like they will. The reality is probably going to get decent interest rate for quite some time, several years probably. But the main disadvantage, particularly with things like CDs, if you get a one-year CD, for example, we all know that you have to lock the money up for the year. If you take it out sooner, you have a payment or you have a penalty. So that's the main disadvantage to a CD, for example. Bonds are another very popular option. You've got treasury bonds, you've got corporate bonds. Treasuries are a little easier to purchase. You can get them directly from Treasury Direct. And you can see 4 or 5% rates on bonds, treasury bonds. The advantage, of course, is they're backed by the U.S. government, so they're considered one of the safer investments out there. The disadvantage, of course, is that you would have to hold the bond for the term to receive the interest. So if you get a one-year bond, for example, you have to hold it for a year. You can buy them anywhere up, all kinds of increments from a few weeks up to 30 years. The other disadvantage is if you don't have a penalty getting out of a bond like you would a CD, but you don't have principal protection. And what I mean by that is if interest rates change in the future, your bond could be worth less. In fact, if you think the markets, or interest rates I should say, are going to increase in the future, your bond will be worth less in the future if you had to sell it. And the reason why is simple. If interest rates continue to stay higher for longer and continue to climb, and bonds are offered in the future with higher interest rates than today, then the ones paying the lower interest, the ones you bought now, would be worth less because they're paying less interest. So let's say you bought a 4 or 5% bond today, and let's say a year from now, you might be able to get 5, 6, 7% on that bond, for example. Well, obviously that 5, 6, or 7% bond is going to be worth more than the bond that's paying, say, 4 or 5%. Pretty much makes sense. So there's some advantages and disadvantages of bonds, of course. But one of the ones I like the most, of course, is the personal bank. The advantage of your personal bank is the insurance company invests in bonds, but they actually have 3 revenue sources. So therefore, they are able to enhance your returns over and above whatever current bond rates typically are. How do they do that? It's really quite simple. They do purchase bonds, which interest rates on bonds has increased substantially, so their profit is higher than ever, which means their dividend is higher than ever. Dividends, of course, are profits of the company. But the other thing insurance companies invest in, what a lot of people don't realize, is they're big contributors in venture capital, some of the biggest venture capital investors out there. Typically, it's a small portion of their overall portfolio because they want to keep 80% or better in safe, guaranteed type of interest rate sensitive assets like bonds. But a typical insurance company will take a small percentage to juice their returns by doing venture capital, pre-IPOs, things like that, high risk, high reward, big institutional investments. And that's where they often then see higher returns than a bond will pay. And the third revenue stream for a typical insurance company, we're talking about life insurance companies, is that they sell financial products. They make fees and various things with selling annuities, life insurance, and other financial tools, just like any financial institution has. So with the three revenue streams, they can offer most often a higher dividend than the bond will pay you. The other advantage to it is they guarantee it. So your principal is guaranteed. Not only that, they have minimum guarantees where you can make 3 or 4% guaranteed no matter what contractually. And the dividends, like I said, are 6% plus now, insured, guaranteed. And here's the big one. Here's the last one. Income tax free. You can buy a bond. I forgot to mention that. Some bonds, state tax free. For some people, that's a benefit. If you do not have state income taxes, then there's no benefit in many states. But if you do have a state tax, most states, let's say Arizona, for example, your state tax is about 10% of your federal tax. So it would reduce the taxes on the gains by about 10%. So it's not significant. But here's another reason why I think it's so important that your personal bank's worth considering. I had a client looking at this, in fact, today. He was looking at bonds. He was looking at CDs. And he's in the state and federal tax bracket of about 25%. And that's about typical average middle-class American. And as he stated, he could get about 5% either on a CD or a bond. But both of those, of course, the gains are taxable. Well, given if it's at a 25% state and federal tax rate, a 5% return gives you a 3.75% after-tax return. You have to take 25% off your return. So again, 5% return minus 25% for taxes means you actually earn 3.75. If you're earning 6% tax-free guaranteed, you're nearly doubling your returns. As soon as I pointed, because at first he said, well, 6%, that's not all that great. I could get 5 with the Treasury. But I said, understand, one's tax-free. The 6% with your personal bank is tax-free, while the bond or the CD, either one, are taxable. So you have to consider what's my after-tax return. So literally, his returns were nearly double. He has much more liquidity with your personal bank. He can access the funds at any time and not lose the interest or the dividends because he can borrow against it using either a bank line or a policy loan. We discuss this on the show all the time. Don't follow that. I'm going to encourage you to stay tuned. Probably in the next segment, I'll share a little bit more on that, or go to yourpersonalbank.com and listen to any of the previously recorded shows where I share how you can access money from your personal bank policy and yet still earn dividends on the money while you access and use it for other purposes. You can get positive cash flow in your money or positive arbitrage. There's a lot of significant benefits, but again, the returns are typically higher and you are guaranteed, so you don't have the risk of loss. And the last point I made on this was he was asking about the safety. This is very important. FDIC categorizes different types of assets in tiers, and they call it Tier 1 capital is considered the safest capital an institution or an individual can own. And they require banks, for example, a certain portion of their portfolio to be in Tier 1 capital to maintain FDIC guidelines. There are only 3 assets that fall under Tier 1 capital, which is the safest capital you can own, the safest investment you can own, according to FDIC. And those 3 things happen to be cash, cash equivalents, which are things like checking, savings, money market type of accounts, and cash valued insurance policy. That is it. Even bonds, treasury bonds, don't fall under Tier 1 capital, and the reason is the value of the bond can be worth less if interest rates climb in the future. cash equivalents, and cash value insurance policy does not lose value. Now, the other argument, of course, we can get to, and that's another whole discussion, the loss of value of the currency, but that affects every asset, doesn't it? That affects every investment. Stay tuned in the next segment. I'm going to share with you a few other things. Because of interest rates going so much higher and people being more interested in interest rate sensitive assets, I need to discuss more about annuities because that is a viable option for a lot of people today. So stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can contact me at yourpersonalbank.com. And yes, you'll reach me. Again, it's yourpersonalbank.com. I've discussed a number of times in the show already about something that many of the experts are getting more and more concerned about, given that we have a slowdown in the economy, slowing GDP, slow growth. We still have high inflation, and we're seeing a slowdown or higher unemployment. And those three things is what's called something called stagflation. Now, what is stagflation? We haven't seen this since the 1970s. And again, stagflation is a combination of slow growth, high inflation, and high unemployment. The problem that stagflation, why it's so insidious, why it's so difficult, is the Federal Reserve, for example, if they try to raise or lower interest rates, it will affect one of those things. If they try to raise interest rates, for example, to slow down inflation, that will actually slow down the economy even further. If they lower interest rates, that will then more growth in the economy, but also higher inflation. They're in a catch-22. It's a no-win situation for the Federal Reserve. This is truly their nightmare scenario. It is the worst scenario possible for the Federal Reserve and really for any economy. And it's looking increasingly likely that we are headed into stagflation for a number of reasons we've discussed on the show many times. Now, one of the key aspects of higher for longer, that's higher interest rates for longer, the Federal Reserve has come out, stated that repeatedly, and repeated that again this week. It's highly unlikely the Federal Reserve is going to lower interest rates anytime in 2024, if not beyond. We just have to accept the fact. It's not necessarily a good thing, it's just the facts. So investments that are interest rate sensitive, the market has been extremely bullish, thinking that we would have reductions of interest rates. I kept saying on the show repeatedly, the Federal Reserve has said the opposite, and the numbers are pointing to the opposite, but yet no one really wanted to pay attention. Well, finally, Wall Street and such, people are starting to actually pay attention and getting off their, what I call hopium, hoping interest rates go down, and realizing finally that, you know what, they're probably not going to go down anytime soon. We need to adjust accordingly. That will very likely affect the stock market. And it will also very likely affect real estate. Higher interest rates are typically not good for those two markets. I couldn't stress to you stronger. Interest rate sensitive assets need to become a bigger portion of your portfolio if you want to thrive through a higher for longer interest rate environment, which is clearly where we're at. It's abundantly obvious. Now, if you get into, as I stated earlier, things like CDs or bonds, you can get higher rates than you could even a year or two ago, but you're going to lock yourself in for longer periods of time. Your personal bank allows you tremendous liquidity, 60 to 85% liquidity day one, literally. So if things did change, rapidly move, you would be able to be nimble and change with it. Here's the thing, when things change, when the economy shifts, when it starts to change, opportunities present themselves. You want to be nimble, you want to be quick, you want to have access to funds so you can take advantage of those opportunities when they present themselves. But there's another thing that we need to bring up and discuss, because this has become now a far more viable option for many people than it's been in over a decade, and that is annuities. Now, I know for some people, annuities have had a bad name, and there's a number of reasons for that, and some of it is well deserved. But here's the thing I want you to understand. There is no such thing as a bad financial tool. There are bad fits, but there's no bad financial tool. And what I mean by that is that each has its own strengths and weaknesses. They're built for a certain purpose. A great analogy is if you told me that a hammer was a bad tool because you were trying to use it to cut wood, well, that is not the hammer's fault. It's not designed to cut wood. You need a saw for that job, right? A hammer is designed to hammer nails. And so what I'm trying to say is I've seen many, many people try to use a hammer to cut wood when they should be using a saw. What I want you to understand is what is the purpose for annuities. Now, the first thing I got to clear up is there's a lot of different types of annuities out there. And secondly, I want you to understand I've been dealing with annuities for 25 years. I'm not saying this to brag, it's just a fact. I was a top 10 producer in annuity sales 4 years running. It's going back over a decade ago for one of the top 2 annuity companies in the United States. There are not many people in this country, in the U.S., that have more experience with annuities than myself. Now, annuities have been sort of fallen out of favor in the past decade or so, and the reason behind that is interest rates were so low. Insurance companies who issue annuities need to have a spread, a bigger interest rate spread, to make a profit, to offer a decent return. Well, they were getting squeezed. Annuities were not very profitable for insurance companies for the past decade because of the low interest rates. That has completely and totally changed and looks to likely stay that way for the foreseeable future. Vanguard, for example, is predicting that bond interest rates are going to be increasing for the next 5 to 10 years. I tend to agree with them because the federal government, as we've shared on the show so many times, has to sell a bond when it spends more than it receives. The government is spending record amounts of deficit spending. It's selling record amounts of bonds, and they have to increase the interest rates on the bonds to entice the bond buyers, the institutional bond buyers, that is, to buy more of them, which forces interest rates higher. Also, while the government borrows all this money, folks, there's only so much money out there to borrow. And if the government's taking a big chunk of it, that means there's less for businesses to borrow, less for individuals to borrow. In other words, there's more demand for borrowing dollars, which forces the interest rates up because the government's borrowing so much of the pool of the available monies. So again, until our federal government starts reducing, well, let's put it this way, until they stop spending more than they receive, there's going to be upward pressure on interest rates. I don't see any effort by either party, any serious effort to reduce spending. In fact, they're doing the opposite constantly. So we're in for a long haul here, folks, a long, difficult haul until the political situation changes in terms of fiscal policies, federal spending. It gives you a tremendous opportunity. Again, the federal government's fiscal weakness and recklessness and all this debt creates an opportunity, either whether it's your personal bank, higher dividends. The historical average, folks, of average dividends is around 7-8%. We're at 6 right now, 6 plus. Quickly going to be heading back to that because of the interest rate environment. But you also can get into annuities where you can have, the advantages are you can have upside potential through indexes like the S&P 500, so you can get strong double-digit, uncapped, unlimited upside potential. For example, I just did a review on a client I did an annuity for last year. They made 23% return last year on their annuity. That was tremendous. That's not every year. Historical averages, by the way, over the last 20, 30 years, if you take 10-year periods, the worst 10-year period I've seen is about 6%, and the best is 11. So somewhere between 6 and 11% is the historical average returns over a decade. Most people, I tell them, you're probably going to fall somewhere in the middle. 7-8% or so, 7 to 9 actually, is the historical average on a better quality index annuity. The other benefit is they guarantee the downside. so you have no losses, and you can lock those in annually. So here's the really awesome part about that client that I met with last week with the 23% return. Well, let's assume they had $100,000 in their annuity. They had more than that, but I'm just going to use that as a simple number. They started with $100,000, you get a 23% return, that's $123,000 in your account. You're credited, and now you're locked in. Your account will never be less than $123,000. We all know anything market related, you can have a great year, but the following year could be a poor year and you could lose some or all of those gains. We all know that. With an annuity, that does not happen. With a good index annuity. Now, I forgot to mention, there's several types out there. There's fixed annuities, there's index annuities, there's variable annuities. They all have different purposes and different goals. Again, there's none that are bad, they just may be a bad fit. For someone who's looking to reduce their market risk, they're concerned about where things are headed, but yet want to grab gains when we do have good years. We're going to have, even if we have a bad year, we'll then have recoveries after that typically. An index annuity can be a great tool. I also have another product right now that's paying 7.9% guaranteed the first year. It's based on the 10-year treasury thereafter, which happens to be right now about 4.5%. If the treasury goes up, you're going to get a higher return. But you also can switch each year to go to index options with like the S&P 500 or other indexes to juice your returns higher if the markets cooperate, again, with no downside risk. Annuities are very appealing to somebody who's looking to invest their money and let it ride for a few years. You can actually start taking money out of it after the first year. And here's the one big limitation on annuities. Here's the negative. You have access to 10% per year. So if you're looking for high liquidity, you want to look at your personal bank and get a solid returns. We can get the same kind of returns with those, but have 60 to 85% liquidity day one. But an annuity can be something that can grow if you're going to let it set and grow. And I see it as a great opportunity for people, particularly with IRAs. IRAs, as most people know, traditional IRAs, 401ks, when you take money out of them, you have to pay the tax because you deferred it. You didn't pay it up front. Well, if you have a traditional IRA or 401k, you don't want to take big chunks out of it in any given year because you're going to get hit with a big tax bill. So that 10% limitation withdrawal each year is not a limitation on a tax-deferred account, a qualified account like an IRA, 401k, 403b, those types of things. So these are all things worth looking at. Again, been out of favor for the last decade or so, but certainly back in favor and will likely be so for the next 5 to 10 years easily as something that could really allow you to thrive, whether it's your personal bank, tax-free, highly liquid plan, or it's an annuity where you just want to see some growth with guarantees so it doesn't go down, get double-digit returns in good years and no loss in bad years. Stay tuned in the next segment. I'm going to share with you some other key thoughts and some encouraging things, so don't miss it.
Stay tuned for more common sense from Ferens. For more information, contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferens Toth. Want more information? Contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferens Toth.
Welcome back to the Your Personal Bank Show. This is Ferens. If you want to reach me, it's yourpersonalbank.com. And yes, you will reach me, yourpersonalbank.com. Been discussing in today's show a lot about the potential of stagflation. That's a situation where we have slow economic growth, high inflation, higher unemployment. And many economic advisors, Jamie Dimon, JP Morgan Chase, many others, are getting more and more concerned we're headed towards stagflation. And frankly, folks, I hate to say this, it's looking increasingly likely that that's going to happen. Just everything's pointing to that. So you have to be prepared for it. And that's why I've been sharing a lot on this show. I've been sharing more financial stuff on this show today than I usually do. because I think it's really important to educate people and understand. The Federal Reserve has come out this week and stated higher for longer. They've been repeating that mantra for a while, but they came out much stronger, and it's unlikely they'll be reducing interest rates anytime in 2024, if not longer. This is the reality we're in. We have to deal with it and plan accordingly. So if you want to thrive in this kind of environment, you want an interest rate sensitive asset. And I shared earlier, if you missed in the show, where your personal bank can really thrive in this environment. So can an annuity, so can some other assets. Well, the one last thing I wanted to share with you. So the advantage of like your personal bank plan, where let's say you're getting 6% tax free versus a CD or a bond today. I forgot to mention this in the last segment. This gentleman I spoke to today, in fact, 25% tax bracket, state and federal, which is again very common for many people. A 5% return means after tax 3.75. Well, if you're earning 6% tax free, you keep 6%. Well, 6% is nearly double of 375. In other words, your returns are far higher with your personal bank because of the tax benefits. CDs, bonds are taxable. And understand some bonds have, you can say they're state income tax free, but that's a far small, federal income taxes are far higher than state, in any state for that matter, even California. So my point is your returns can be far, far higher with your personal bank or an annuity, depending on what makes sense, like an index annuity. Double-digit growth in good market years, no downside risk, and on bad years, 10-year average of the last 20 years, you're looking at a low end of 6% and the high end of 11%. Those are the ranges. Those are the real numbers. That's what's really happened. So forget the noise, forget the propaganda, what you may have heard or somebody told you that an annuity was bad, quote unquote. There's bad fits, but there's certainly a place for them. Just like it's a tool, like any other tool. Some tools work better than others at different things. What I try to do is find out what somebody really wants, really listen to them, find out what their goals are, what they want to accomplish, and then give them the tool that fits that the best, not the one that I think would work best for me or what I think they want to hear. I'm going to tell you what you need to hear, not what you want to hear, because that's how you make better financial decisions. I'm going to treat you like an adult. And I guess that kind of segues to my last point I really want to make, because everybody always says they love it when I get into the political stuff and how it affects us economically. And I do have some of that stuff I need to share today. I want our federal government to start treating us like adults and quit lying to us. And here's an example, and this is something that's going to affect all of us economically. So apparently, over the last year or two, a couple of years, it was 8 months, January through August of 2023, this is official now, about 200,000 illegals were flown into the United States illegally without crossing the border or being reported, and they sent the majority of them to Florida. 90,000 to Miami, 60,000 to Fort Lauderdale alone, directly from their country into ours, taxpayer expense. We paid for the flights, no vetting. They have no idea who these people are, anything about them, just flew them straight in. That is going to affect our country, and it's going to affect our country economically in big ways. Here's why. I'll give you an example. Florida recently passed a law requiring hospitals to publicize the cost of unpaid care for illegals. And the report so far, just in 2024, this is only May, okay? They've already had to pay Florida hospitals over $500 million, and taxpayers are paying for most of it. That's just Florida, folks. So $500 million in health care has gone to hospitals just for the state of Florida for the first 4 months of 2024. What's the real bill? Far higher than most people would probably realize or guess. But here's some other things that we've seen. There's been student protests recently on college campuses all over the country. And many people are asking why. Well, there's a simple answer. Do you know that at Northeastern, 58% of students are foreign? At Columbia, 55%. Many of these colleges, especially the Ivy League elite colleges, have high percentages of foreign students who have no affiliation for our country. In fact, many of them actually absolutely hate our country. And you wonder why they demonstrate against our country and yell death to America and stuff like that. Well, when you realize gifts from for American universities from foreign countries, they're getting paid like Saudi Arabia. It's like almost $1.5 trillion gifts to our universities. China, 1.7 trillion. Qatar, $3.2 trillion to American universities. Why are they giving so much money to our universities? What's in it for them? But I love this one. The White House, of course, the Biden administration has been giving money, student loan forgiveness left and right to buy votes for young people. And this latest one was just for students who attended art institutes. I mean, give me a break. Apparently the average savings of those people is $19,000. You want to talk about a bribe to buy votes? There you go. They're also, White House has so far been very silent if anti-Israel protesters will be barred from student loan forgiveness. What do you want to bet? The answer is no. They're going to get their student loan forgiveness anyway while they scream and yell death to America and kill all the Jews, right? That seems right and fair. This bill of 95, almost $100 billion that was given to Ukraine, Israel, and Taiwan primarily. I've already stated in the show, it's been, it's documented that $9 billion of the $25 billion that was supposed to go to Israel actually goes to Hamas. Well, it goes to Palestine, Hamas, those people. What do you think they're going to do with it? So we're giving, not of the $25 billion, we're giving whatever that is, $16 billion to Israel, and we're giving $9 billion to Hamas. They're at war with each other. We are directly funding both sides of a Middle Eastern war. Can you see anything that could go wrong with that? Is that a good use of our tax dollars? Actually, it's not even tax dollars because they printed it because they don't have it. So we're paying for it through inflation and increased debt to fund both sides of a war. But on top of that, it's now come out, part of the Ukraine funding, there's a provision in there that $3.5 billion for the State Department is going to be used to set up refugee centers in Muslim-majority countries to make it easier to import Muslims directly into the United States. As I stated earlier, they already flew in something like 200,000 illegals in 8 months from countries all over the world. Now they want to bring in Muslims and fly them in directly, and we're paying for it. $3.5 billion. Thank you very much, Congress. Anyone who voted for this, get rid of them. Vote them out. Replace these people. We are paying for our own destruction, and it's causing economic chaos in the meantime. In fact, I saw a picture here, and I thought this was really eye-opening, but it's a picture of Nazis preventing the Jewish students from entering colleges. This was the University of Vienna in 1938. It was ironic how similar that picture is to what we saw recently in college campuses of Muslims, Palestinian supporters, Hamas supporters, blocking Jewish students from entering their college. I never thought in my lifetime I would see something like this. We are truly living in times that are not necessarily good. And I like this one. The government will arrest citizens that don't pay taxes, but use our tax money for illegals that aren't even supposed to be in our country. Try to make sense of that. And one of the best things I ever saw, and I'm going to share with you a couple of good thoughts and finish up here in the last few minutes. So a lot of people have asked me, and I do this regularly, talking to people that don't necessarily have the same political beliefs. Obviously, most times they're very liberal. But I love this story, and I thought this was so powerful. I hardly ever read anything on the show, but this is so powerful, I need to do so. So there was this young woman, she was about to finish her first year of college, and like many her age, she considered herself liberal, and among other liberal ideas, she was much in favor of higher taxes to support more government programs or redistribution of wealth. And her dad, of course, was a staunch conservative, and they did not see eye to eye on this. So one day she was challenging her father on his opposition to the higher taxes on the rich and need for more government programs. And he responded, he asked her a simple question. He said, he said how she was doing in school. And she said, well, she's doing great. She had a 4.0 GPA. And she then was telling how tough it was to maintain. And she had a difficult course load. She was working hard. She wasn't able to go, have fun, go to parties like a lot of people she knew because she was so studying, working hard. She didn't even have a boyfriend because she was studying, unlike many of her college friends. And then her father asked her, what about her friend Audrey? And as she said, her friend was barely getting by. She's taking easy classes, hardly studies, going to all the parties, and very popular on campus, just basically partying her way. And she had like a 2.0 GPA. He said, well, why don't you go to the dean's office, ask him to deduct 1 point off your GPA and give it to your friend who only has a 2, and that way you'll both have a 3.0 GPA, and certainly that would be fair and equal distribution. And she was shocked, and she, went, that's not fair. I worked hard. She's goofing around and partying and everything else. Why? And all of a sudden it clicked. It clicked in her head. If somebody works hard and does well, and they save and they make good decisions and all those kinds of things, and somebody else is goofing around, refuses to work, do any of those kinds of things, and does far worse, why should that person that sacrificed, worked hard, and all that have to give to the person that goofed around and didn't do anything, and frankly didn't deserve it? And that's a great story to share if you want to help somebody understand why redistribution of wealth, high taxes, taxing the rich and all, is inherently unfair. And I guess I want to finish on a thought here. There's only 2 defining forces that have ever offered to die for you. Jesus died on the cross for your soul, and an American soldier died for your freedom. Think about that a minute. As frustrating as things get, there's encouraging things going on these days. You see these fraternity brothers in the University of Chapel Hill and Carolina supported the American flag and kept it from hitting the ground for about an hour while they were getting attacked and pelted by Palestinian supporters. That's the future. It's encouraging. Don't give up. This country is worth fighting for. Our freedom is worth fighting for. Don't let it go. And as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.